The June jobs number looks stronger than it really is. I want to be clear though, I wouldn't say this was a bad report, but the headline number that showed an addition of 147,000 jobs in the month of June doesn't necessarily show the full picture. The number did come in well above the estimate for 110,000 jobs, and it does follow upward revisions in the months of April and May that totaled 16,000 jobs. But the concerning part that I saw was government accounted for 73,000 new jobs in the month of June, essentially half. This did not come from the federal government though, as it actually saw a decline of 7,000 jobs, but rather it was state and local governments which added a combined 80,000 jobs in the month. Most of this increase in state and local government came from education, and the speculation is that this had something to do with seasonal adjustments, and that obviously these massive gains will not continue moving forward in state and local government. Other areas though that were strong included healthcare and social assistance, which was up 58,600, leisure and hospitality, that was up 20,000, and then construction also looked good too, as that was up 15,000. Many of the other areas though, they were quite muted, and actually manufacturing and professional and business services saw a decline of 7,000 jobs each in the month. There was good news on the unemployment rate, as it did tick down to 4.1%, which was actually the lowest level since February and came in below the expectation for 4.3%. Unfortunately, this largely came due to the decline in the labor force participation rate, which dropped to 62.3%. This was the lowest level since late 2022. The problem here is that the working age population continues to shrink while the retirement age population continues to grow. In fact, the prime working age participation rate was recently near a record high of 83%. So again, they're at work. It's really just those people in retirement continuing to grow. A potential problem to future job growth, though, is the fact that we are running low on workers in their prime working years. This report largely erased any chance of a Fed rate cut in July, but I would say there was more positive news on the inflation front, as average hourly earnings saw a manageable year-over-year increase of 3.7%. As I said, this wasn't necessarily a bad report, and in fact, I would say it continues to show the labor market is in a good spot for the most part, but it definitely wasn't an overly strong report, as I said. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.